At CBS MoneyWatch, a continual theme is that one of the biggest obstacles to your financial success is your own unhelpful impulses. Humans simply are not hardwired for the self-restraint, patience, and long-range thinking that it takes to succeed in investing. Our guest today has a unique insight into what might help you behave a little better in your own self-interest as an investor. He's Phil Maymin, an assistant professor of finance and risk engineering at NYU Polytechnic Institute in Brooklyn, New York. Phil, thanks for joining us.
Thanks for having me.
Now, a lot of people have long said that investors are their own worst enemies, but you have a unique database into that. How'd that come about?
It's my co-author, Greg Fisher. He's the founder and chief investment officer and president of Gerstein Fisher. And he started a Gerstein Fisher Research Center to look into what we can learn about individual investors based on his unique data set. Now, what is his data set? What's his database? When he started his firm in 1993, he still kept it on index cards, but every time a client called him, or he called a client, or one of his salespeople interacted with a client, it was all written down. And in 93, if you can remember, there was no internet, there was barely any databases or spreadsheets, but over time it's evolved and it's become a comprehensive 600,000 records. And you can read these over time. You can see these people. It's almost like reading into their brains.
Okay, so you have this insight into how investors are thinking at this
Yes.
firm. What are they doing that's so bad?
They get emotional. The problem with emotions is there's too many of them. There's only one way to be calm, but there's thousands of ways to be emotional. You can be happy, you could be sad, you can be whatever, anything in between.
You could be greedy, you could be fearful.
Yes, and those things tend to happen when the market is doing particular things. So if the market is very, very, very high and it's just rolling every day up and up, people start to feel less risk averse. They think, well, what am I sitting with only 60% of my assets in equities? Let's roll the dice. It has been going up, it will keep going up. What am I doing here on the sidelines? If the market is very volatile, whether it's up or down, it's just bouncing around a lot, it's on the front page of everything, on your site, on everything,
Yes.
right? You feel more tense. Right. So then you're going to call more. The interesting thing there is they don't call more because the market expectations of future volatility have increased. It's that the recent volatility was high. It's what just happened.
What might happen.
Even if the future is the same as it would be in the past based on market prices, you still feel the anxiety and you still call.
Now, were the financial advisors able to keep the investors from acting emotionally?
By and large, that is their job. They do try to keep investors calm, remind them that they're in it for the long run. They try to educate them to think about things a little more patiently. And that's why people hire them, is to help them become a little bit more patient.
In the work you did with your partner, you used the metaphor of a college student who once was trying to avoid binge eating overnight.
Right.
And he finally settled on the stratagem of locking the refrigerator door and giving the key to his roommate.
Right. It's a quirky little 3-page study in 1978, but it has so much insight about human nature. He had just recently lost some weight. He was in good shape, but it was his finals, and he was stressed out. One day, he opened the refrigerator, and he saw a pastry, and he ate it, and that's it. After that, he just started eating more and more, binge eating, and he didn't want to. He knew this was wrong. He was trying to lose weight. He knew this was having thousands of calories at night. This was bad. So what did he do? What you said worked. Locking the door, giving away the key. That helped.
Well, how did the financial advisors act as a door lock?
Most studies have shown that trading more frequently is bad for you, the same way as binge eating is bad for you. And the analogy goes through. So it's finance and food. They're similar things, and you can keep them in mind. So an investment advisor, one of the roles he does is to keep you from trading. Another role is to educate you. There's also other roles like tax advice and all sorts of things.
So, Phil, a lot of people can't afford a financial advisor. What can you do yourself to act as your own refrigerator lock?
What does it mean you can't afford it? Maybe you can't not afford it. If you're the kind of person that trades frequently, most research suggests that you're probably losing about 4% per year. So maybe in that context, maybe if you were to get an advisor who would just keep you from trading that much, maybe the advisor costs you 1 or 1.5% per year. Maybe that's a trade-off that you might want to do. And maybe that's part of the decision-making process that people who have investment advisors, that's part of what they're choosing them for, is to keep them from doing too much trading.
Some people would advise that one of the smartest things you can do is just not look at the performance of your portfolio. Don't look at your brokerage statements when they arrive.
If you see it every single time, every month or whatever, you're more likely to see negative numbers, and negative numbers hurt more than positive numbers feel good. So if you think about it that way, if you're seeing losses all the time, even if it's 50-50, right? If on a monthly basis, if you see losses half the time, gains half the time, even if the average is growing, those losses feel twice as bad, and you're going to get out.
So, yeah. So you'll be hurt, you'll make a bad decision.
Right.
So don't look at your brokerage statements, but be sure to watch CBS MoneyWatch.
Of course.
Every day. Phil, thanks very much.
Thank you.
And thanks for watching.